All right, let's dive into one of the most powerful and honestly most misunderstood tools in a real estate investor's arsenal, the 1031 exchange. This is the secret sauce that savvy investors use to legally push a massive tax bill way down the road and seriously accelerate their wealth.
So picture this. You just sold an investment property and you made a great profit. That's awesome, right? But before you even pop the champagne, you know who's coming knocking? The tax man, looking for his cut. So the big question is, what if there was a way to keep all of that hard-earned money working for you?
I mean, just look at the difference. It is night and day. With a 1031, your entire $500,000 in equity goes right into your next deal. Without it, boom, you're out 65 grand to capital gains tax before you've even started shopping. That is a massive chunk of your wealth building engine. Just gone. And that tax bite is, without a doubt, the number one hurdle investors face. It feels like every time you make a good move and sell a property, you get penalized for it. It just makes it that much harder to trade up and grow your portfolio. But what if you had a secret weapon, a financial tool that lets you just sidestep that penalty? Well, that's exactly what a 1031 exchange is. It's a way to turn what would have been a tax payment into the down payment on your next big thing. So what is this thing really? It all comes from Section 103 of the IRS tax code. And it basically says this: if you sell a business or investment property and you turn right around and reinvest all of the money into another similar property, you get to defer or, put off paying those capital gains taxes. And here's probably the best way to think about it. It's like getting a constant interest-free loan from the government. You're literally using money that you would have paid in taxes to instead boost your buying power for the next property. And the best part? You can keep doing this again and again. Now, here's a key detail. You can't do this by yourself. The IRS insists that you use someone called a Qualified Intermediary, or QI. Think of them as the neutral referee in this whole game. They're a third party that holds your money between the sale and the purchase, which is critical for making sure you follow the rules, and we're about to get to those. So the IRS gives you this incredible benefit, this superpower. But in return, they demand that you play by their rules. And let me tell you, these rules are strict. They are totally non-negotiable. This timeline is everything. The second you close on the property you're selling, a clock starts ticking. You have exactly 180 days, that's about 6 months, to buy your new property. But here's the real pressure point. You only have 45 days to officially identify which properties you might buy. Remember this number, 45. It's not a suggestion, it is a brutal, unforgiving deadline. You have to give your qualified intermediary a written list of potential properties by midnight on that 45th day. There are no extensions, no excuses, no exceptions. So how many can you pick? Well, the most common way to do it with a 3-property rule. It's simple. You can identify up to 3 potential replacement properties, doesn't matter what they're worth. You just have to end up buying at least one of them from your list. Okay, besides the timeline, there are a few other core rules. To put off all the tax, you have to buy a new property that's worth the same or more than the one you sold. Both properties, the one you sold and the one you buy, have to be for investment or business, so no, your personal home doesn't count. And finally, you cannot, under any circumstances, touch the money from the sale. That's why the QI is so critical. They hold the cash for you. All right, enough rules. Let's get to the exciting part. Let's see how you can actually use this tool as a strategy to seriously level up your portfolio. Let's say you own a piece of raw land. Sure, it's gone up in value over the years, which is great, but it's not making you any money month to month. It's just sitting there. Well, by using a 1031 exchange, you can sell that land and, without losing a single penny to taxes, roll every bit of that equity into a cash-flowing apartment building. You've just swapped a lazy asset for an income-producing powerhouse. Or how about this? Maybe you own 3 or 4 smaller rental houses, and managing them is just becoming a total headache. You can use a 1031 to sell all of them and consolidate all that money into one larger, more efficient, and probably more profitable building. Seriously, the possibilities are almost endless. You can move your investments to a better state, you can swap that old high-maintenance property for something newer and easier, you can constantly level up your income. But here's the real mind-blower. You can keep doing this your entire life. And when you pass away, your heirs can inherit those properties at the current market value. And that entire lifetime of deferred taxes, it can be wiped away for good. Now, anytime you have a tool this powerful, you're going to get a lot of myths and misunderstandings floating around.
So let's do a quick reality check and bust some of those right now. Myth number 1, you're swapping properties with someone. Nope, totally false. You sell your property on the open market and you buy another property on the open market. Myth 2, like kind means you have to buy the same type of thing, like a house for a house. Also false. Any real estate held for investment is like kind. You can swap land for a condo, an office for an apartment building, and finally, the myth that this is only for giant corporations. No way. It works just the same for a small rental condo as it does for a huge shopping mall.
So what's definitely off limits? The IRS is very, very clear here. Your personal house, the one you live in, does not qualify. A vacation home that you use most of the year yourself, that's not going to work either. And all those fix and flip properties, those are out too. The IRS sees that as inventory you're holding to sell, not as a long-term investment. Okay, listen up, because this is the single most important thing I'm going to say. You must, absolutely must, hire your qualified intermediary before you close on the property you are selling. If you close first and that money hits your bank account for even 1 second, the game is over. The exchange is blown. It's the most common and most devastating mistake you can make. Which brings us to the big final question. When you really get it, you see that a 1031 exchange isn't just some clever tax trick. It's a fundamental strategy for building real generational wealth. So I'll leave you with this. How could keeping 100% of your profits working for you over and over again for decades, or even forever, how could that change your financial future?